Imagine it's November 2001. You're a 42-year-old schoolteacher living in Buenos Aires, Argentina. You live in a small apartment with peeling cream paint, a radio in the kitchen, and a savings account that finally feels safe after years of inflation. Your salary arrives through the bank. Your rent is paid on time. On Fridays, you stop at the bakery downstairs, buy bread for the weekend, and tell yourself that the worst years are behind you. The peso is tied to the US dollar, so 1 peso feels like one real dollar, as solid and clean as the marble floor in your branch bank. Your students talk about computers, imported shoes, and a future that sounds modern. The country feels tense but normal, like a theater set with the lights still glowing and the audience still seated. If you have ever wondered why an economy can feel most normal right before it breaks, stay with me. What you're about to hear is not a theory. It is a pattern. It has happened in different countries and different decades under different flags. And if you find value in this kind of historical clarity, subscribing takes 2 seconds. It keeps you ahead of what most people never see coming. Then the whisper starts. People are pulling money from the banks. On that same day, bank runs begin and more than $1.3 billion leave Argentine accounts. Within hours, the calm surface starts to crack. And within days, the government limits withdrawals, protests spread, unemployment hits 18%, supermarket looting begins, and President Fernando de la Rua is gone by 20th of December. That is the subject of this video. Why does an economy often feel strong, stable, or at least survivable right before it falls? Why do the shop windows stay bright right up to the night the power goes out? History shows that collapse usually does not arrive like a lightning strike from a clear sky. It arrives like a bridge giving way after years of hidden rust. The traffic still moves, the paint still shines. The danger is in the steel underneath. Before we go further, there is something important to understand. A falling economy rarely announces itself honestly. In the final stretch before a crisis, the numbers many people watch can still look healthy. Jobs may still be there. Stores may still be open. Credit may still be easy. Asset prices may still be rising, which means houses, land, stocks, or bonds are becoming more expensive on paper. That paper wealth feels like real wealth. It changes how families spend, how banks lend, how politicians speak, and how newspapers tell the story. But underneath that bright surface, the engine is often running on borrowed fuel. Credit, which means debt created by banks and lenders, can make an economy look stronger than it really is. It is like pumping air into a balloon inside a house and mistaking the expanding walls for a bigger home. For a while, everything looks larger. People feel richer. Business owners hire more workers. Tax money flows in. Leaders claim success. Yet the whole structure is becoming more fragile because it now depends on rising prices, easy refinancing, and confidence staying alive. That is the secret key. Right before the fall, many economies feel strong, not because the foundation is solid, but because the final phase of a boom is often the noisiest. The cranes are still moving. The banks are still smiling. The consumers are still buying. The very forces creating the illusion of strength are the same forces making the crash worse when it comes. Stability breeds risk. Success invites excess. Calm becomes camouflage. This brings us directly to Japan. In late 1989, Japan looked like the future made visible. Tokyo glowed with money. Office towers rose like polished spears. Land was treated almost like a magical substance. The belief spread that Japanese land prices simply did not fall for long. That myth mattered. A myth in economics is not just a false story. It is a social permission slip. Once enough people believe it, they borrow against it, build on it, and stake their careers on it. The Nikkei stock index reached 38,915 on 29th of December 1989. Tokyo condominium prices had roughly tripled from 1986 to their peak in October 1990. Commercial land prices in Japan's 6 biggest cities kept rising into September 1990. To many households, that looked like proof of national strength. The country had world-famous manufacturers, high savings, and global prestige. People did not think they were dancing on a thin pond in winter. They thought they were standing on granite. Now here is where it gets interesting. The bubble was not just about greed or irrational excitement. It was also about system design. Financial deregulation in the 1980s gave banks new ways to gather money and push out loans. Expectations of low interest rates helped convince investors that big property bets were safe. Banks poured money into real estate and construction. Once land and stocks rose, they could be used as collateral, which means assets pledged as security for a loan. Rising prices made more borrowing possible, and more borrowing pushed prices even higher. It was a mirror facing a mirror, creating the illusion of endless depth. Ordinary people felt this in very ordinary ways. A family apartment seemed more valuable each year. A company's land holdings made its balance sheet look stronger. A bank manager could point to collateral and feel protected. A young office worker in Tokyo or Osaka did not need to understand monetary policy to sense that the whole country was moving upward. Bonuses felt secure. Promotions felt likely. Spending more did not seem reckless. It seemed like keeping pace with reality. But asset booms can hide a simple trap. If the price of a thing rises because more debt is chasing it, then the prosperity attached to that price is partly borrowed from the future. It is tomorrow's demand being dragged into today. That makes the present look muscular while quietly hollowing out the future. Look at what happened next. The stock market began dropping in January 1990. By $30 June 1992, the Nikkei had fallen to 15,951, less than half its peak. Property followed. The economic expansion that had started in November 1986 peaked in February 1991. Yet even after prices turned, many people believed land would soon recover. The old myth survived the first blow. That is another reason economies feel strong right before they fall. Belief does not break at the same speed as prices. The mind stays in the old world for a while, even after the old world is gone. And this is where history gets uncomfortable. Japan's collapse did not feel like a clean, cinematic moment. It felt slow. Businesses kept operating. Streets remained orderly. But balance sheets were damaged. Banks sat on bad loans. Growth weakened. What looked like national wealth turned out to be inflated paper values tied to a credit machine that could no longer keep expanding. The rot had been in the beams, not on the surface. By the time the surface changed, the damage was already done. The counterintuitive part is that Japan did not feel ruined the moment markets turned. The stock market peaked at the end of 1989, but the broader expansion did not officially peak until February 1991. That lag is crucial. It shows how a society can keep moving forward on habit, credit, and denial long after the first crack appears. Companies still opened their doors. Trains still ran on time. Restaurants still filled at lunch. The pain took time to move from asset markets into payrolls and bank balance sheets, and once banks were loaded with bad loans, they often delayed recognizing losses. A bad loan is simple. It is money lent out that is unlikely to come back. But banks rarely rush to admit that in public. So weak borrowers were kept alive, weak banks limped forward, and the country entered what later became known as the lost decades. A bubble does not always explode like a bomb. Sometimes it sinks like a ship taking on water below deck, one sealed compartment at a time. Here is something I want you to think about before we go further. If your salary is steady, your neighborhood is busy, and prices around you keep rising, how would you know whether you are living through real strength or borrowed strength? Drop your answer in the comments. Seriously, because what I'm about to show you next is the part of this story that most people never hear, and it changes everything. The second major clue is that fast growth can hide a currency trap. Thailand in the mid-1990s looked like an economic miracle. Bangkok was booming. Office towers climbed into the heat. Foreign money poured in. Across the decade before the crisis, several East Asian economies were growing at rates above 5% and often close to 10%. To investors, policymakers, and many citizens, that seemed like proof that the model worked. The Thai baht was pegged to the US dollar, which means its exchange rate was kept tied to the dollar. That peg made the system feel steady. If the currency looks stable, foreign borrowing feels less dangerous. It is like borrowing on a boat because the sea looks calm at the harbor. But the calm was deceptive. Years of rapid domestic credit growth had built up heavy leverage, which means too much debt sitting on top of too little real cushion. Real estate was overheating. Banks and companies borrowed heavily from abroad, often with short repayment periods. The currency peg hid the exchange rate risk. As long as the baht stayed fixed, the debts looked manageable. The moment that peg failed, the local currency cost of those foreign debts would jump. Ordinary people did not wake up each morning thinking about external debt maturity. They saw new buildings, new jobs, easier loans, and a city that seemed to be racing toward developed country status. Shop owners stocked imported goods. Young workers moved to urban centers. Families believed they were stepping onto an escalator that only moved up. That is the emotional power of the late boom. It turns a temporary arrangement into a personal future. On 2nd July 1997, Thailand devalued the baht after months of pressure had drained its foreign exchange reserves. That date matters. It is one of those calendar points when a hidden mechanism becomes visible. Once the peg broke, the whole machine reversed direction. Thailand's currency, equity, and property markets weakened further. Across the region, capital inflows slowed or reversed. In the first 6 months of the wider Asian financial crisis, the Thai baht lost more than 50% of its value. The Indonesian rupiah fell by 80%, the South Korean won nearly 50%, and the Malaysian ringgit about 45%. More than $100 billion in capital inflows vanished from the worst-hit economies in the first year. Think about what that means at street level. A firm with foreign debt suddenly owes far more in local money. A bank that looked healthy last month is now sitting on weaker borrowers. Investment projects stopped midstream like cranes frozen over half-built towers. A shop in Bangkok hangs a sign offering 50% off because customers have lost spending power. The problem is no longer abstract. It is rent, payroll, medicine, and school fees. This leads to the second part of this story. Why did Thailand feel strong right before it fell? Because the very things that made it look successful also attracted the kind of money that can leave fast. Growth drew foreign lending. The currency peg masked risk. Rising property values encouraged more borrowing. The system looked efficient because nothing had yet forced it to absorb a shock. But a shock always reveals what growth alone can hide. A tall tree in still air tells you nothing about the depth of its roots. Now we move to the United States before 2008, because this pattern is not confined to emerging markets or currency pegs. It also appears inside the world's largest economy. For many Americans, the years before the Great Recession felt solid. Home prices had more than doubled between 1998 and 2006, the sharpest increase in modern U.S. history. Home ownership rose from 64% in 1994 to 69% in 2005. Residential investment, which means spending on housing construction and related activity, rose from about 4.5% of GDP to about 6.5%. Roughly 40% of net private sector job creation between 2001 and 2005 came from housing-related sectors. In March 2007, the unemployment rate was 4.4%. That is the part many people forget. Right before the disaster, the surface looked normal enough for millions of households to keep making long-term plans. They bought homes, refinanced mortgages, renovated kitchens, changed jobs, and sent children to college. A housing boom is powerful because it does not feel like a boom to the people inside it. It feels like adulthood. It feels like progress. A rising home value can make a middle-class family feel safer, more established, even wiser. The house becomes a mirror reflecting back a story of competence. But the mirror was warped. Mortgage debt of U.S. households rose from 61% of GDP in 1998 to 97% in 2006. That is a huge shift. It meant more and more of the economy depended on home values staying high and credit staying loose. Lenders pushed mortgages into weaker hands. Those loans were bundled into securities and sold across the financial system. Risk was sliced, packaged, and moved around so often that many people believed it had disappeared. It had not disappeared. It had only changed address. Now observe the mechanism. Rising home prices created collateral. Collateral created more lending. More lending brought in more buyers. More buyers pushed up prices further. Construction jobs multiplied. Furniture stores sold more sofas. Local tax revenue increased. The economy looked healthier because the bubble was feeding employment, spending, and optimism all at once. It was not just a house price story, it was a national mood story. The bubble was not sitting on the economy. For a while, it was the economy. Then prices peaked in 2007 and fell. Mortgage defaults spread. Financial institutions discovered that assets they had treated like solid stone were more like painted ice. From peak to trough, U.S. GDP fell 4.3%. Unemployment rose from less than 5% to 10%. By February 2010, employment had fallen by 8.8 million jobs from its pre-recession peak. In 2008 alone, there were more than 3.1 million foreclosure filings in the United States. What did ordinary people live through? Locked moving trucks, half-built subdivisions, parents explaining to children why they had to leave their house, construction workers losing jobs that had seemed permanent, retirees seeing savings damaged, small businesses watching customers vanish. The floor did not collapse only under speculators. It collapsed under families who thought they were standing on the most ordinary dream in America. Another uncomfortable fact is that the late boom trained institutions to confuse liquidity with solvency. Liquidity means having cash today. Solvency means truly being able to pay what you owe in the long run. During the U.S. housing boom, many firms had liquidity because markets were open and lenders were still willing. That created a false sense of health. Homeowners could refinance, banks could borrow, investors could roll over short-term funding. When that flow stopped, the difference between temporary access to money and real financial strength became brutal. The same house, the same mortgage, the same borrower could look safe in spring and fragile by autumn. Not because the walls changed, but because the credit pipe feeding, the system was suddenly pinched shut. That is why the months right before a crash can look almost absurdly ordinary. Children still go to soccer practice. People still grill in the backyard. Television ads still promise easy loans. The trap is dressed in everyday clothes. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you are still here, you are not most people. Hit subscribe. Because the next section is the part this channel was made for, the part they never put in textbooks. Now look at all three together. Japan in 1989, Thailand in 1997, the United States in 2007, the same mechanism, different countries, different decades, same result. In each case, the economy felt strong because debt was turning rising prices into visible prosperity. In Japan, land and stocks made balance sheets look invincible. In Thailand, fast growth and a stable exchange rate made foreign borrowing look safe. In the United States, housing wealth made households, lenders, and local governments feel richer and more secure. Different costumes, same actor. At this point, the pattern becomes impossible to ignore. Late-stage booms do not merely hide weakness, they produce the exact signals people are trained to read as strength: rising employment, rising asset prices, easy credit, confident headlines, political self-congratulation, foreign investment, consumer spending. These are not always lies. They are often real, temporary effects created by an unstable expansion. That is why the pattern is so dangerous. It does not depend on everyone being foolish. It depends on many reasonable people responding rationally to distorted signals. Think of it like a building where each bright floor is lit by electricity drawn from the same overheating wire. The light is real. The activity is real. The profits may even be real for a time. But the system holding it together is becoming less stable with every additional floor. There is another common feature. The final phase often feels safest because memory has been trained by success. In Japan, people remembered land recovering. In Thailand, years of growth made vulnerability easy to dismiss. In the United States, decades of faith in housing and finance made widespread doubt seem almost unpatriotic. When a boom lasts long enough, it rewrites common sense. People stop asking whether prices make sense and start asking why they did not buy sooner. And there's one more point most people miss. Crises are often revealed not by one giant problem, but by a break in refinancing. Refinancing means rolling old debt into new debt. Many systems survive only because borrowers can keep replacing old obligations with fresh credit. When that process stops, the illusion burns off quickly. What looked like wealth becomes a payment schedule. What looked like abundance becomes dependency. And this is where history gets personal. The people who suffer most are usually not the ones who designed the system. They are the middle-class savers, wage earners, pensioners, and small business owners who trusted the visible world in front of them. Go back to Argentina. For much of the 1990s, the country looked like a model of stability. Inflation had been crushed after the peso was pegged to the dollar in 1991. Foreign investment came in. Even in 1997, when lenders were pulling money out of East Asia, capital still flowed to Argentina. That made the system feel validated. Yet public debt rose from 35% of GDP in 1995 to nearly 65% in 2001. Investors eventually demanded about 35% yields on Argentine 10-year bonds in late 2001. Then came the bank runs. What did ordinary people live through? On 30th November 2001, over $1.3 billion left the banks. The government imposed a $1,000 per month withdrawal limit. Protests began on 1st December. By 13th December, unemployment had hit 18%. Looting followed. On 20th of December, President De La Rua resigned after riots that left 28 people dead. The middle class learned a brutal lesson. An account balance is not the same thing as usable money when the banking system locks its doors. Savings behind glass are like water behind a frozen pump. Now look at Greece in June 2015. Banks shut until 6th of July. ATM withdrawals were limited to €60 a day per card. People lined up for hours in Athens and Thessaloniki. One Saturday alone, Greeks withdrew as much as €600 million before machines started running dry. Pension payments and electronic wages were officially protected, but daily life still tightened like a belt pulled one notch at a time. Imported medical supplies needed approval. Foreign transfers were restricted. The social pain came not as one dramatic explosion, but as 1,000 small humiliations. Waiting, counting, delaying, explaining. This is the human cost of economies that feel strong before they fall. The strength is not evenly owned, but the collapse is widely shared. A banker may lose status. A fund may lose value. But a wage earner loses time. A shop owner loses customers. A pensioner loses confidence in a lifetime of saving. A young family loses the years it took to gather a down payment. Crisis is a machine that turns abstract fragility into intimate damage. And yet some people do come through these periods better than others. Not because they can predict every crash, not because they are morally superior, but because they tend to recognize the difference between surface stability and structural stability. They understand that a calm sea is not the same thing as a seaworthy ship. The historical record shows that those who came through these periods largely shared three characteristics. First, they were less dependent on rising asset prices. In Japan, firms and households with lower debt loads were not as crushed by falling collateral values. Second, they were less exposed to one single point of failure, such as a frozen bank account, a single employer tied to a bubble sector, or debt in a currency they did not earn. In Thailand and Argentina, mismatch was fatal. A mismatch is when your obligations live in one world and your income lives in another. Third, they adapted early. They cut leverage, preserved liquidity, diversified income, or reduced reliance on fragile institutions before the crowd fully understood the risk. The record also suggests that survival was often less about chasing the winning asset and more about protecting room to move. Room to move matters. In a boom, people are rewarded for commitment. Buy the house, expand the store, borrow for the next project, hire for expected demand. Tie your future tightly to the story of continued growth. But when that story breaks, flexibility becomes a form of wealth. You can see this in a humble way across different crises. In Japan, companies that were not buried under property debt had more time to adjust. In Thailand, firms with income linked to exports were better placed than firms that borrowed in foreign currency while earning only in baht. In the United States, households that had not stretched every dollar toward a bigger mortgage could cut back and survive the shock with less damage. In Argentina and Greece, people who had access to more than one channel of income or more than one place to hold working cash were not immune, but they were less trapped. The winners, if that word even fits, were often not the boldest people in the room. They were the people who kept a second door unlocked. They understood that modern economies can look like castles while functioning more like stage sets, beautiful from the audience, fragile from behind. They respected concentration risk, which means too much of your life depending on one asset, one lender, one employer, one currency, or one political promise. When the set catches fire, the person standing near the side exit has an advantage over the person admiring the scenery. There is a moral lesson hidden here too. Late booms reward imitation. Everyone feels pressure to copy the neighbor, the rival firm, the louder investor, the confident minister on television. But historical survivors were often willing to look temporarily wrong in order to avoid becoming permanently trapped. That quiet refusal to follow the crowd is one of the oldest forms of resilience in economic history. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing. And it might change everything. Notice what is missing from that list. Perfect timing. The survivors in history were not always the smartest people in the room, and they were rarely prophets. They were usually the people who respected fragility before it became fashionable to do so. They were suspicious of booms that required everything to keep going right. They treated unusual prosperity the way a sailor treats sudden warm wind before a storm, not as proof that storms are over, but as a reason to check the ropes. They also tended to understand a harsh social truth. In every boom, public status gets attached to visible confidence. The person expanding fastest looks visionary. The cautious neighbor looks timid. The company raising the most money looks strongest. The one turning down debt looks out of date. But history has a dark sense of humor. The people mocked for moving slowly are often the ones still standing when the music ends. They do not always win big. Often they simply avoid being broken. In a real crisis, that matters more than glory. In the United States, households with fixed-rate mortgages, lower debt burdens, and more cash flexibility were better positioned than those who had stretched to the edge. In Argentina, people with access to dollars outside the banking trap, export income, or family networks abroad often had more room to breathe than salaried workers tied entirely to the domestic system. In Greece, businesses with foreign customers or stronger cash buffers could absorb restrictions better than shops living day to day on local turnover. These are not heroic stories. They are usually quiet stories. The people who endure are often the people who left themselves options. That may be the most counterintuitive fact of all. In boom times, caution looks like stupidity. Keeping buffers looks timid. Refusing easy debt looks old-fashioned. Doubting a national success story can even make you seem disloyal. But when the tide goes out, flexibility matters more than brilliance. A rigid life breaks. A flexible life bends. So what present-day echoes should matter to anyone studying this pattern? Not prophecy, not panic. Echoes. History suggests that when an economy feels strongest because one class of assets keeps rising, when debt grows faster than income, when large parts of job creation come from a single hot sector, when politicians point to short-term calm as proof of long-term health, and when refinancing becomes the hidden oxygen of the system, caution becomes more valuable than confidence. That does not tell us when a break comes. It tells us what kind of strength deserves skepticism. Return now to that teacher in Buenos Aires. At first, nothing about her life looked like a prelude to national breakdown. Her salary still arrived. Her students still came to class. The bakery still opened in the morning. The bank statement still showed numbers. Then the difference between money and access to money swallowed everything. The peso peg broke. Inflation came back. The old certainty dissolved. What had felt like solid ground turned out to be painted wood over a deep hole. That is why economies often feel strong right before they fall. Because collapse is not a switch that flips from healthy to broken. It is pressure building inside structures that still appear to function. The buses still run. The office is still open. The headlines still celebrate growth. But beneath the floorboards, debt is piled up. Risk has been hidden, and the system has become dependent on conditions that cannot last forever. History does not tell us the future in advance, but it does tell us how illusions are built. It tells us that late booms are often loudest at the end. It tells us that what feels safest can be most exposed. And it tells us that the people who suffer most are usually the ones who mistook visible stability for real resilience. Resilience means the ability to absorb a shock and keep functioning. Many economies look strong because no shock has hit them yet. That is not the same thing. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it, but if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.